Instead of you going out and investing in a company like Amazon, now what you're going to do is you're going to invest in a group of companies. If you invested in the Amazon company, you put all of your money into this Amazon stock and Amazon takes over the world, this would be great news for you as an investor because now your stock price would soar. But if Amazon does something bad and the CEO runs the company into the ground and then they declare bankruptcy, well, now your investment go down to zero. So when you invest your money into the individual company, you're taking on more risk. You can see more upside, but you could also see more downside. And this is where there's a lot of work required to find the right company, to research the right company, and then you have the psychology aspect to actually how do you invest in the company. When's a good time to buy? When's a good time to sell? And this is why the majority of people lose money in the market because they don't have the time to do the research, they don't know how to do the research, and they don't have the psychology to invest their money in the stock market. That's why for the majority of people, it's a much better idea to invest in these types of funds because now the way it works is instead of investing directly into the Amazon company, you're going to invest into this fund which owns the Amazon company. And in addition to Amazon, it might own some McDonald's, it might own some Coca-Cola, it might own some Nike, it might own some other stocks in here. And now you have this basket of maybe 100 stocks or 500 stocks or 1,000 stocks. So now, if Amazon takes over the world, well, you're going to see some benefit here in the fund, but it'll be balanced out by some of the losers. However, if Amazon went bankrupt, then the fund would kick Amazon out and put another company in. So now you're not going to be hurt as bad by the Amazon bankruptcy because now they will replace it with another company and it'll be balanced out by some of the winners. So when you invest your money into these types of funds, you don't have to worry about doing the same type of research if you're trying to find the perfect company because now this fund, whether it's an ETF, a mutual fund, or an index fund, is working to have the right group of companies there for you. That way now you're investing in a particular index, a particular basket of stocks, and I'll explain what that means in just a second, but you're picking this basket that you want to invest in, and then this basket will readjust based off of what companies should fit there. That way it's not a permanent group of companies. If Amazon goes bankrupt, it'll be kicked out and maybe Chipotle will come in. So these types of funds lower your risk, meaning they lower your downside, but they also lower some of your upside. However, if you're just trying to meet the returns of the market, these funds can allow you to do that without all the time and without all the risk. Now, how do you find these types of funds? Well, this is where you can look at ETFs, mutual funds, and index funds because they work similarly with a little bit of differences. So let me start by talking about mutual funds because these are what are generally known as actively managed funds. That means that the person who's managing the fund is actually a person. They're typically a well-educated money manager who you're going to be paying a fee to manage. Now, the good side here is you have somebody there trying to find you the best stocks to keep in this fund. The downfall is it's going to cost you more money. The fees are going to be higher. Sometimes the fee will be worth it. Most of the time, it will be not. Now, mutual funds work similar to index funds in that they have some restrictions. If you want to invest your money into a mutual fund, most of the time, they're going to have limits to how much money you have to invest. There will typically be a minimum. It might be $100, it could be $5,000, it could be upwards of $5 million, just depending on what the fund is. But there will generally be some minimums in order to invest. Not all of them have minimums, but some of them do. And then many times, mutual funds will also have restrictions on how often you can buy and sell this fund. Unlike a stock, you can buy Amazon and sell it within the same minute. When you buy a mutual fund, you don't have the same ability. Many times, not all the time, but many times, you can only buy the mutual fund or sell it once in a day, and there's only one slot to do that. So you can buy it only once in a day, so you can't trade out of these funds. This is kind of similar to index funds, but the difference between index funds and mutual funds is that index funds are generally passively managed. And what that means is now instead of having a money manager manage it, you are going to have a computer managing the fund. What that means is now you can build an algorithm that I'm going to invest in an index of the biggest 500 companies in the stock market. This is what the S&P 500 is. So now when you enter this algorithm, the computer will automatically make adjustments when it needs to be done. If Amazon goes bankrupt, well, then the computer will kick Amazon out and they'll put in the next biggest company. Now, the advantage of this is your fees are significantly less. Now, sometimes this will be great, other times not, but overall, what we've seen throughout history is for the average person, the higher fees tend not to be worth it. This isn't the rule 100% of the time, but generally higher fees mean it's going to eat up more of your profits. Then index funds many times also do have the same minimums like mutual funds do. This can be as low as $100 up to millions of dollars depending on what the fund is. And then index funds many times also have the same restrictions where you can't trade in and out of an index fund the way you can a stock. ETFs work very similar to index funds, but they can be actively or passively managed. So these are active or passive, but the difference between now ETFs and mutual funds and index funds is they trade just like stocks. So you have no minimums generally unless there is a brokerage that you're working with that doesn't allow you to buy a fractional share. For example, if the share of an ETF is trading for $100 a share and you don't have $100, some brokerages will let you buy a fractional share for $20. So you're buying $20 of a $100 share. But besides the restrictions to buy a fractional share, there's generally no restrictions to buy an ETF. There's no minimums and you don't have the restrictions because now you can trade in and out of an ETF whenever you want. This is where I want to remind you that if you want to succeed as this type of investor, this is called passive investing. If you want to succeed as a passive investor, the key is you have to be a long-term investor. And by long-term investor, I don't mean 6 months. I don't even mean 6 years. A passive investor is somebody who wants to invest in these passive investments for the next number of decades. When you have that type of long-term horizon, you can win as a passive investor, but you have to be in it for the long term. Personally, I'm a big fan of ETFs because of how easy they are to access, but for other people, that's exactly why they hate ETFs, because they don't want to have to sit there and monitor the stock brokerage accounts versus an index fund or a mutual fund. If you're buying it directly from the investment institution that's issuing it, well, now it's much simpler on your end because now you don't have to stress about what's happening in the stock market and staring at your stock brokerage portfolio each and every day. It kind of happens a little bit more discreetly because you're not seeing the day-to-day price moves the way you are with an ETF. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.